How's it going, everybody? Welcome to episode 155 of the Doots, the weekly Doots podcast, dailydoots.com, designed and produced by our own very own Hanny Abu. Hey, it's good to be here, man. It's been a long, hot summer, as you can see from the title. It's a vaporwave desert kind of day here in Kansas City. We're going to be hitting, I think, our fifth day in a row of being over 110 heat index. I don't know. Maybe I'm just making up shit at this point, but it's good to have everybody here. I know that the world is pretty hot in general, and sideways action on the Ethereum price and a little bit of Ethereum drama going on in the EF, or bits and pieces of the former EF. I kind of don't even want to go over it. I think it's just it's just indicative of like, hey, we got shit to work on at the protocol level, and people are still trying to figure out how to govern the damn ship. And the ship is the size of like 6 battleships, the weight that it's carrying out there in the real world. But yeah, pretty cool to have everybody along for the ride. We are streaming on I think 5 different channels, 2 of them on X. Follow at EV Mavericks on X. You can follow me at ProDJKC on Twitter as well. EV Mavericks has a Twitch channel, and I'm streaming, of all places, LinkedIn. Why not, huh? And then YouTube, of course. So welcome, and thanks for hanging out today. If you guys want to jump in on this action, you can head to dailydoots.com, and we've got links to all of our places to be, but our main show takes place on Discord. It's not token gated. Anyone can join the conversation. I'll be kind of looking at Discord too. If you want to raise your hand, jump on stage, you got something to talk about in relation to the Doots, that would be great. So the Daily Doots is all about showcasing the best of the week that was from the daily general discussion on our Ethereum on Reddit. It's a read-along reaction series. If you want to read along, you can head on over to dailydoots.com, designed and produced by our very own Hanny Abu. So everybody that makes the Daily Doots gets a point by me, and then the A word curates a list of the week's best Doots. I don't read any of these out ahead of time, but let's just jump in right away. We'll get right into our rich list for this week. As of right now, we have 1,340 Dooters. I think that's low. This needs to be updated. I think we're over 2,000. We're getting there anyway. Ethical trade is at 121, the A word at 127, crypto currency at 145. Hanny Abu climbing up the ranks this week, breaking away to the 7th spot at 146. JS Tears at 170. Tricky Troll, who curates all of our daily Doots, is at 183. Benito 2030 is at 185. Super Fizz is at the big 250 mark. LogrisTheBard has climbed up 1 point to 265, and Harog sits at the top of this week's list, as always, at 368. All right, very good. Well, let's go right into the weekly roundups. Again, these are all hand-selected by one of our EV Mavericks, the A word specifically. Oh, by the way, we do have guests coming up. We've got Quotient coming up next Friday, and we have the Zao was all coming up on the 28th. So excited to get some guests back in the calendar. If you know anybody that wants a piece of this action, just send them our way. We love trying to highlight all the teams and all the people that are out there working in the Ethereum landscape. All right, here we go. Let's see the morning roundup. As of this morning, Hitman 616 chimes in. Ethereum, this is our trifecta. And Frank the Tank price is $1,880. M4G lock at the ratio of 0.02971. I feel like the ratio has made somewhat of a recovery. I think didn't it go all the way down to like 0.25? Yeah, this big dip right here. This was looking back whenever that was. But yeah, it's just been steadily climbing up on that ratio, creeping up. Are we going to get a Sunday surprise? That would be fun. We'll see if that happens. Maybe, maybe not. But Sundays sometimes get a little crazy. The weekly haiku, courtesy of JS Tears, money frame by frame, privacy instead of fame, Ethereum game. That's very good. How does he do it, JS Tears? JS Tears delivers a daily haiku every single day. Ethereal News, hosted by A.B. Kotha, fellow moderator on Reddit. Ethereal News Weekly, number 35, the big 3 takeaways. Justin Drake is saying that Poseidon is abandoned. ETH coordinate evolved from ETH stakers. So now instead of ETH staker, it's ETH coordinate, end of an era. I don't even know how to say this word because it's got a funky symbol on it, but I'm going to say Plata Berget. Glamsterdam public testnet is now live. You can get all of these articles and more at ethereal.news, produced by one of our very own moderators. Our ship post of the week comes by way of Crypto Wow Currency because we always like to save the best for first. Here's a helpful template for you all. Your post advocates a cap-based, identity-based, market-based, or vigilante-based. The approach to incentivize solo staking. Your idea will not work. Here's why it won't work. One or more of the following may not apply to your particular idea. So let's go back. So your post looks like about staking. The approach to incentivize solo staking. Cap-based, identity-based, market-based, or vigilante. Okay. One or more of the following may apply to your particular idea. Nobody will be able to enter the staking set anymore. Large stakers can split their stake up into a bunch of small 32 ETH validators. Large stakers can cheaply rent a bunch of IP addresses to assign validator traffic to. Large stakers can anonymize their staked ETH to hide the very fact that they're a large staker. Solo stakers will be incentivized to stake with an institution instead of solo staking. Specifically, your plan fails to account for the following. Laws expressly prohibiting it in most countries globally. Lack of centrally controlling authority for authorizing new validator entries. People assigning the withdrawal addresses to a contract. People trading ownership of validators without ever actually exiting them. And then you got your generic asshats. And the potential dangers of weird, unproven consensus mechanisms. Huge existing investment in ETH by institutions. Looking at you, Tom Lee. Eternal arms race involved in all approaches to identifying how much stake an entity controls. It goes on. Profitability of large stakers splitting stake and pretending to be a bunch of solo stakers. Dishonesty on the part of stakers themselves. Malicious software that stakers write themselves and run on their staking rigs. Geth, okay. And the following philosophical objections may also apply. Ideas similar to yours are easy to come up with, yet none have ever been shown practical. Any scheme based on opt-out is unacceptable. Interactions with the beacon chain deposit contract should not be the subject of legislation. Block lists suck. Allowed lists suck. We should be able to stake any 32 ETH no matter where it came from without being censored. Countermeasures should not involve sabotage of public networks. Countermeasures must work if phased in gradually. Spinning up a solo validator up and down should be essentially free. Rotating keys for a solo validator should be free. Why should we have to trust you and your server? Incompatibility with open source licenses. Feel-good measures that do nothing to solve the problem. Temporary time-limited validators are cumbersome. I don't want the government vetting the origin of all my ETH. Killing them that way is not slow and painful enough. Furthermore, this is what I think about you. Sorry, dude, but I don't think it would work. This is a stupid idea, and you're a stupid person for suggesting it. And finally, nice try, asshole. I'm going to find out where you validate and slash your entire stake. Oh, boy. Adapted from craphound.com/spam solution. All right. I'm going to be quite honest. I don't quite follow what this was, but it sounds like a selection of options based off of the staking situation unfolding. We'll move on. If anybody wants to jump on stage, just raise your hand. I'm happy to have a co-host. It looks like Logri is not going to make it today. All right, Someday It's Dark revisits the issuance discussion after working through research and user PA7X1 for patiently answering questions. By the way, user PA7X1 this last week, believe got a double doot on one of these days. PA7X, I got an update to my res storage. Hold on, we're going to update this because this has changed. Yeah, PA7X1 is a Deuter 109. They went up 4 points this last week. They had a lot of input on the daily. And Someday It's Dark is a Deuter number 37. Okay, so this is revisiting the issuance discussion. Okay, Someday It's Dark writes, okay, user PA7X1, I believe I really understand the analysis here now. Solo stakers are disadvantaged on the current and proposed curves unless we implement some sort of uncorrelation incentive or a correlation penalty, which is not actually part of the proposal. So I still do not see how we are not accelerating the effective end of solo staking with this proposal. I do see how it can be slightly more fair as they die off, though. Am I mistaken? Sorry, I missed a sentence here. Are there any uncorrelation incentive or correlation penalty proposals being considered in tandem? Am I mistaken? I've poured through the analysis. I believe I understand it fully. I certainly appreciate it. Thank you for all that you have done to put this together. User PA7X1 replies, any staker that has a higher presence of fixed costs is always going to be disadvantaged under any curve. This is not fixable purely through issuance. If you compare a solo staker with an LST holder, the solo staker has worse economy of scale because it has higher fixed costs. The fixed costs are nasty. They are the ones that eat you away in low issuance. Up to here, these are very general facts that hold true across every single issuance curve. Here's the crucial point. When an issuance curve implements stake capping means bringing the yield to zero at some target stake ratio. Two things happen. Big entities have a roof on how much ETH they want to stake. This happens because the curve has a maximum issuance. In the proposed curve at 20% staked, so if a single entity were to hold 21% stake, the extra 1% staked would start reducing its income. So that disadvantages concentration of stake. Second bullet point, the region at which the solo staker, the poorest economy of scale, and the LST holder cease to stake, shrinks and gets compressed towards the point where everyone gets pushed out. Currently, with reasonable estimates of the cost structure of a solo staker at 60 million ETH, you will not earn enough to compensate for the inflation of ETH. At that point, solo stakers are just a shrinking pie bound to disappear over the long term, while LST holders are fine up to 110 million ETH approximately. That creates a huge region where we are just slowly killing solo staker. If we wait a few years and stake keeps growing as it has been doing and shows no signs of slowing, then we will sleepwalk into that region and then it's game over. Solo stakers will disappear. It's not even a matter of them unplugging their machines. They will just get diluted away. What implementing stake capping does is ensure solo stakers that are viable economically much closer to the point where everyone is, so that we don't have a region between 60 million ETH and 110 million ETH staked where everyone just holds LSTs because there's no other alternative. To further improve the situation for solo stakers, we need other things. Lower hardware requirements. This is coming with statelessness and ZK proving, lowering machine costs, and lower fixed costs. Introduce a second bullet on this to improve the situation for solo stakers. Introduce uncorrelation incentives or stronger correlation disincentive. This would help give an economic advantage to uncorrelated stakers, which solo stakers would benefit from. Today, Oysen presented an EIP about this. And so Someday It's Dark says, okay, I'm up to speed now. You've been extremely patient, so thank you again for that. So in regards to Oysen presenting an EIP, Someday It's Dark says, well, I missed this, so I will check it out. Can I just say this whole situation absolutely sucks? Back when proof of stake was being discussed with EIP 1011, and we were going to need 1,500 ETH to solo stake, which even back then was a disheartening and impossible amount, I kind of thought that long term, if Ethereum were successful there were good odds that a majority of ETH would end up getting staked, and it would turn staked ETH into some weird low APR internet bond. Apparently, this was maybe right, but I previously never construed it as a bad thing. We spent years engineering different proof of stake arrangements like EIP 1011, but kept re-engineering them until we got to the merge. There were countless discussions about an existential slashing crisis throughout, and yet somehow We got to the point today where a supermajority bug is a valid argument for making changes to the issuance curve. I guess I don't know when the misstep was. I think it's just going to be tough to be a solo staker. Wear that badge with pride, fellas. F it. Some days it is dark. Hell of a post there. If you guys have any questions, they should pop up on my screen on Restream here if you put in any comments in YouTube, if you have anything you want to add or say. And, of course, stop by dailydoots.com, jump on the Discord stage. The links are all right there. Okay, user Rhythm of ETH wonders what 300 million gas after Glamsterdam could mean for Ethereum, leading to an interesting discussion with Edmund Edgar, fellow moderator, about on-chain storage. Rhythm of ETH for this week is a Deuter number 111. Rhythm of ETH writes, I wonder if people realize that after Glamsterdam, the gas limit can be raised to 300 million gas, which means ETH turns deflationary at 2.66 Gwei base gas. This is deflationary ETH. While a simple transaction costs barely 10 cents, because obviously ETH will be 10K, right? Let's do something to make sure 100% of that available block space finds great use, and maybe discuss issuance for the fork, elf fork, as a community and researchers had already agreed. It's not a trivial thing to utilize fully 300 million gas blocks. Any EIPs for that, aside for gas repricing, which also ships on Glamsterdam? I like this one for quick slots, and it's at the Ethereum.org site. It's EIP 8198. It would bring back a lot of use cases lost to Alt L1s and L2s. It would virtually trade some of the gas limit for faster slots. The total gas throughput would remain the same. One interesting drawback is that it could enforce harder constraints on the ZK EVM roadmap. Edmund Edgar responds, well, let's see, this is in regard to the gas limit, the ETH turning deflationary portion. Edmund writes, what does this mean in terms of data? For a while, I wanted to put a DID PLC directory on there. Rhythm of ETH says, well, I'm afraid that 300 million gas is amazing for throughput, but underwhelming if you're looking for permanent data. 300 million gas limit is basically 25 million gas per second throughput, regardless of slot speed. Your options after Glamsterdam are this. There's 3 bullets. Call data history. This is a 40 gas per byte. It's a new floor from EIP 7623. You get 7.5 megabytes per block or 625 kilobytes per second. This is just napkin math. Here, technically, you risk nodes dropping it. This is due to EIP 4444. On to blobs now. Obviously the cheapest, but you need to re-upload the directory every once in a while because these are ephemeral, as we all know. And finally, permanent state. Permanent state is S-Store, which is 20K gas per 32 byte slot, or 625 gas per byte. Or the S-Store 2 contract code trick is roughly 200 gas per byte, and only 0.5 to 1.5 megabytes per block, 40 to 120 kilobytes per second. This is the only that puts on Ethereum the way I think you mean. Edmund goes on, I'm not familiar enough with it, but DID PLC full export uplog seems to be in the order of tens of gigabytes. This is just napkin math. Permanent state, 2 bullet points here. Permanent state seems the reasonable one, but there's some talk of disincentivizing it further. If you are stubborn and patient, you can use anywhere between 2,000 and 4,000 ETH to put 10 gigabytes on Ethereum if there's no congestion. Blobs would require a funny rolling update to keep the data alive. Each blob is 128 kilobytes, costing 138,000 blob gas. It says kilobits in this one. Blobs expire every 2.5 weeks or so, which means you repost at least 20 times. 10 gigabytes would be 80,000 blobs, so you'd need to publish 1 blob every 2 blocks. Very unlikely you remain stuck with anchoring to a Merkle root checkpoint on chain, and the rest in ephemeral storage. This remains basically a roll-up use case. That was highly technical. Rhythm of ETH and Edmund Edgar nerding out over Glamsterdam stuff. All right. This looks like a relative new name. Alatar Hun, Alateral Hun, provides a detailed explainer of the EIP 8363 debate. Duder number 4, yes, relative newcomer. Welcome to the weekly show. Congratulations, you made it. Call your mom. Alatar Hund writes, context. Ethereum's issuance policy, this is number 1. Ethereum's issuance policy was changed in a somewhat expedited but conservative way several years ago, with an expectation that the topic would eventually be revisited. Number 2, some stakeholders now believe it needs to be revisited relatively soon because too much ETH is being staked, putting downward pressure on staking returns and potentially creating broader distortions. Number 3, the optics of the proposal were poor from the outset. It was submitted just before the proposal deadline and tied to a named upgrade, Hegota, creating the appearance of putting the cart before the horse. Number 4, there are also fundamental differences in incentives across small stakers, large staking operators, LST providers, and institutional custodians, which inevitably pulls companies such as Coinbase into the debate. Number 5, the proposal may directionally be valid, but it is aggressive and by design, and in my view, too lightly evidenced to support a policy shift of this magnitude as currently written. Here's the summary. The current Ethereum curve pays lower percentage yields as more ETH is staked, but the total issuance continues rising, and staking yields never fall much below roughly 1.5%. EIP 8363 argues this could eventually push a very large share of ETH into staking custodians, ETFs, LSTs, and institutional operators. The proposal would do the following bullets. Calculate a burn based on the total staking balance, burn part of every validator's idealized attestation, proposal, and sync committee rewards, increase that burn as the staking ratio rises, fully offset the consensus issuance at 60.25 million ETH stake, approximately 50% of the current supply, and finally phase the permanent yield reduction in over 18 months. The proposal does not model the following. The desired dollar value of slashable stake under major ETH price declines, operator concentration under different yields, regulatory coercion and custodial correlation, MEV concentration, institutional versus solo staker yield sensitivity, and the effect of future consensus improving rules. All right, there's a whole chart about the approximate permanent yield. It's a heavy topic right now. I feel like going back like Tom Lee and Bitmine and like just even some of these bigger institutions that were buying swaths of ETH. People are like, yay, they're staking. It's going to dilute the supply and the price is going to go up. And it's like, man, the price did not really go up and more shit just keeps getting locked. And so like, I think it was LogrisTheBard said in the episode last week, he's like, we wouldn't have any of this concern if we had more apps just generally burning the shit out of ETH and the price was higher than it is now. And now it's like we're trying to engineer a way out of like, it's like the self-choking, what is it, where the frog is in the swan's throat, but the frog's hand is coming out of the swan's throat and choking it, you know? It's like choking itself in a way. I don't know. It's kind of interesting. It's definitely top of mind right now. Pretty incredible. I'm going to adjust this light real quick. You listen to this little song. I'm back. That was perfect. I was doing some product shots. Been doing some video work. Still looking for video work. If you know anybody out there who needs somebody to do whatever, I'm in. Okay, especially crypto related. I miss doing some of that stuff. Man, wife's blowing up my phone. I gotta get on with it here. User Master Roshi9 spots some interesting. Oh, here I got some comments on Discord. Here we go. There we go. Zal says, who else could give me the EL? Explain like I'm 5 of today, LMFAO. I'm loving the dude energy. I need to post to Ethereum subreddit more. That's the goal for this week. Let's go. Let's do it. You'll have fun. It's pretty cool. A really cool thing is you can look on the leaderboard at dailydoots.com and you can see where people are. So if you're on Reddit, well, let's just do it, right? So let's say you're on Reddit here. Now, my screen, this doesn't really help you guys because I have a moderator toolbox on here. But let's say, here's one, Woodpecker Horror 3468. If you get in a conversation with somebody, just copy their name and just go and see like where they're at on the leaderboard. So if I paste in his name, he's been duded 7 times. So that's not nothing, right? Like if you find people on Reddit, you're like maybe disagreeing with them or they're an obvious troll, they're going to have probably next to nothing for a dude score. And of course, it's all subjectively handpicked anyway by our team. But at least like you can figure out kind of who the heavy hitters are because we've been doing this system for years on Reddit now. I think we're in like year number 3. This is episode 155. We started the Doots podcast way after. But yeah, like Master Roshi 9, right? Is that who we're talking about right now? I can't remember. Anyway, if I put in Master Roshi 9 and you hit enter because they have a lot of good quality posts, there you go. And you can follow people on Reddit too. But if you just want to get an idea of who you're talking to, and look at here, 1,340 duders. I thought it was higher than that for some reason, but it doesn't really matter. You get the idea. So it's a kind of an interesting way that we do Reddit. There's no other community that uses. I mean, I'm using like a moderator or Reddit enhancement suite to hand tabulate all of these scores for all these different accounts. And there's just some really good people. I've met a few of these people in real life. But like Harog Duder 368, that's like God legendary status. Nobody's that. I mean, he's 100 more points ahead of second place, who's also a freaking legend. LogrisTheBard, Tokenomics Explained Doc, and Superfizz at 250. But you could see like there's quite a few people that have well more than 10 on our list. Let's just count all the people that have more than 10. So 219 people have been nominated to the top of the daily. That's pretty significant. That means Tricky Troll found their content to be useful and they got nominated, and then I graded the score. It's just that easy. It's just a simple social way to kind of get a grasp of who's talking about what and how often and how much they're around versus like people that use Reddit or Twitter to drive by post and all that stuff. We do a really good job like curating a good community out. Okay, yeah. Speaking of user Master Roshi 9 spots some interesting on-chain trends and wonders why they might start the signal of a new bull market. I'll take that. Well, it's easy to become jaded during a bear market while we all wait for the world to catch up and for ETH to move, but it's always important to stay clued into what's happening on chain. I continue to be encouraged by more on innovation and on-chain experiments and the emerging trends. More and more, I'm becoming convinced that it may be an indicator of a shift into the beginning of a new bull market. Here's what I've been noticing the past couple of weeks. Bunch of bullet points here. Perps platforms continue to print revenue. Everyone knows Hyperliquid and Lighter as the leaders. More exist. Some are pre-token. Competition seems tough, and I'm not knowledgeable or interested enough in this sector to comment. Moving on. A meme token on Robinhood. I know memes suck, but keep reading. A listing on Robinhood was aggressively front-run. Trading meme tokens is more and more a losing game without an incredible edge. Not just insider info, but the ability to monitor the chain as well. Here's an interesting article outlining the situation. At the same time, meme token launchpads are telling incredible revenue stories. Pump, Pawns, FOMO app, and now Uniswap are all doing well. But I hate this sector, and the competition is everywhere. I can't help but think the last point will create more losers and stunt this at some point, but who knows? Trading card collection platforms are doing incredible revenue. The biggest names are Collector Crypt on Solana and Monster, I think, on Mega ETH. I'm not particularly interested in trading cards, but I think this is worth watching. Oh man, pour some out for Gods Unchained. I may or may not be a Genesis holder. NFT infra and the new models surrounding tokenization is a new sector that I'm absolutely paying attention to. And for the first time in the bear, has caused me to take positions and speculate. And I'll talk about these next because they're more interesting to me. All right. Good. Fake World Assets. Now, these are the two big names to watch in the NFT infra game. Fake World Assets, which is on mainnet, which I've talked about here, is seeing a steady daily volume and burns the token for revenue. NFT users can put their ETH and NFTs at risk to earn from gamblers who pay ETH to spin a gotcha front end. I don't know what that is, GACHA, for rewards. Currently, the highest reserve-backed NFT is a 300 ETH reward or a CryptoPunk. That liquidity is raking in nearly 1.5 to 2 ETH a day for that punk owner. The product has only been live for a couple of weeks, but had already been forked and built on a ton. The creator has more ideas as well, apparently. On the token, market cap is very low on this, so there's a big upside potential and a big bust potential. And number 2, stonk brokers. This is Robinhood chain. It pairs a reserve of NFTs against their token using a new Anvil AMM they created, which prices NFTs at static quantity next to an ERC20 token. They paired Stonk Broker NFTs in reserve with an ERC Stonk Broker token to create a liquid floor on the NFT. Others can provide liquidity too. Trades of the token create revenue, which purchases a war chest of stocks. And NFT holders burn Stonk Broker tokens to activate higher shares of this and other revenue streams. Each Stonk Broker NFT has an attached wallet embedded, which travels with it. The other revenue stream is a cut of trading from projects that issue NFTs and tokens using the Anvil AMM. So far, there's been one project to do this, which literally launched yesterday. Stockbroker NFTs recently passed Pudgy Penguins and are selling on OpenSea at a market price of 7-ish ETH, with a floor of 6-ish through the token. The token and project has been live for about a month, and the token has run nonstop, so be cognizant of that. That's it for my update on current on-chain games and trends. No investment advice, of course, but the advice I will give is to start paying attention if you haven't been. New things are happening on change, and that has always predated bull markets in the past. Well, there you go. Is this like 2017 again? Finally, got a little people building games and trying to do some shit again in the NFT market. It's good. Let's see, on the public stage chat here on Discord, got some comments here. Next Level Fantasy in regards to app development that LogrisTheBard was talking about. Next Level Fantasy says, amen to all that. There's so little app level funding, though. Yeah, that's a good point. These apps ain't going to build themselves. You know, people got to eat. Got to get that machine going again. And Zal says, I got to follow some people on Reddit. I never follow people on Reddit, LOL. Yeah, the easiest thing to do is like just open up the daily and just kind of cruise through it every now and then. You'll start to make a memory bank of the people that you connect with the most. Zal continues, I want to make a meme token called PFOF on Hood Chain to explain how Robinhood's business model is selling their clients' trades to market make. RIP Gods Unchained. I'm a big TCG guy. Yeah, that's yeah, I bought a lot of those packs. They were fun to open up. My thing with Gods Unchained is I was never into Hearthstone, and I really wanted to see if my son could play. And I think there was always this rumor that there was going to be a tournament. Because my son's smart. He gets it from whoever. I don't know. I need to get a paternity test. My son's a pretty damn smart kid, and it'd have been neat to see him play. But he ended up not really liking the game dynamics. It was a little... I don't know how to put it gently. I think it was a little too nerdy for him to try to figure out all the combinations of cards to get and all that stuff. Yeah, and Zal agrees gameplay was not great. Saltorius made a tournament for Gods Unchained. I still like it though. I mean, there was a lot of work that went into the art, and I like the sounds, and I don't know. I tried playing it. It was a little beyond my brain, but I mean, they still have players. They still got a Reddit, and there's still people playing. I just without knowing any data or metrics, who knows? But anyway, moving on down the list. Good stuff. It's cool. It's cool to see people posting about things that they're following out there. I don't want to minimize that. I think it's really interesting to see people talking about projects again and being excited. Something else about the stunting of the bull market. I think war is a big problem. You could say what you want about Trump. He did bring a lot of crypto pack money to the table, which and I think there was a lot of leadership from the right, not just Trump, but leadership in general from the right that was obviously catching tailwinds and helped put crypto in front of Congress and finally the Senate. And we get the Genius Bill passed. But I feel like for all of the headway that has been made in the last 4 years 2 years really, but maybe 3, of all of the headway that has been made in the positivity and the turning of the tide of the conversation in a positive way for crypto to be instituted correctly, not as a central bank digital currency, but hopefully as a privacy preserving thing. And obviously money, all these things, like all of the good shit that was being helped out and moved forward has all been but eliminated because of one dude. And that's Donald Trump and his incessant grift on the industry. I stand by that. Some people, listen, I'm not a fan. I've not ever really been a fan of that dude, but I was for a lot of the stuff that was happening on the right that was helping the industry. But my God, man, like the amount of money that dude has made off the backs of crypto while in the presidency has absolutely caused a lot of people, including Republicans in the United States, to separate themselves. And that's why I think Clarity Act didn't get passed. I just feel like it's such a sour note right now. And I'm starting to hear in the news flow and everything like that, there's a very good chance we may see some people on the right divorcing themselves from the crypto lobby in the midterms. And that's that. And we'll see. Hopefully we don't. I feel like what is the way I'm trying to say is like, yeah, you can eat too much of your cake. It's just, there's no limit to just how much damage that dude, among other sectors, really the crypto industry just suffered. I don't know. Got to reframe maybe it comes from the left. Maybe it comes from the left moving forward. Maybe the lobby decides, we'll try to work on people on the left and try to bring it around that way where it's actually good for the common person, the working man. We'll see. Anyway, enough of that. Yeah, there we go. To be honest, Zal says the presidential meme coin ruins everything legitimate about the blockchain. At least ruins the perception of everything about the blockchain. I don't know. We'll just see. I feel like it's a bit demoralizing. And I can understand why so many people are leaving the industry because they just don't want to touch anything that has that much potential for grift in the highest offices of the land. They just want to get on with data centers and AI, which has its own problems. But I'll move on. Good. Let's see. Rhythm of ETH. Okay, yeah, here we go. Rhythm of ETH. Again, this is a duder. This is 2 weekly dudes from Rhythm of ETH. This is a good egg. Shares an alternative proposal to preventing stake growth. All right. According to x.com, this is an X. Let's see. Let me find the article. An attempt to balance Ethereum staking. Oh, this is by Toast. Okay. Okay, so this was this was some of the charts that we saw in the previous thing. Okay, so according to this post by Toast, Rhythm of Ease says the numbers do not work to me. But the mechanism is inherently simpler, doesn't mess with issuance curve excessively, only sets a hard limit, instead focusing directly on what needs to be addressed. You could tweak the numbers to make it work, but most importantly, it goes to prove that the tapered burn EIP is equally opinionated and even more, tries to achieve more than it needs, and messes with too many things by fully reconstructing the issuance curve. The only reason perfectly rational and smart individuals would drastically modify the issuance curve is that they want to address more than 2 or 3 dynamics of the protocol. This amount requires a deep second-order effect analysis. They should be upfront about this and not try to pass this EIP as a simple change. Postscript. Just as I was writing this, EIP proposers have started conceding a few points and validating concerns. I thought all this challenging was uncalled for. Ethereum-magicians.org EIP 8363 tapered issuance burn. You can go check that link out. Or you can come find it on dailydoots.com. User Harog, our top of the heap guy, weighs in on EIP 8363 and incentives for the decentralization of the staking landscape. And then user UAP 44 builds on this with a good point about the importance of long-term ETH issuance policy. Oh, this is a big post here. I want to look up UAP 44's Deuter score. So Deuter number 2, responding to Harog, making it on the show too. This is a pretty long read here. Okay, pretty much everything has been said about the issuance change in the last few days. I loved reading all the different opinions, some more nuanced and some more opinionated. What I will write below is my view and is pretty much that. My view with my weight of priorities. Feel free to have different opinions. I've already written about my general view about issuance 3 months ago and provides a link. I provide much of the same opinion as back then. Issuance is here to pay for a service, namely providing Ethereum network with security. If issuance is used to loop LSTs around or bring TradFi into the space, then they could take advantage of it, but only as long as the actors actually provide the security they're getting paid for. LST loopers can cost the space quite a bit as well, and the recent RS ETH hack made pretty clear. The 3AC meltdown in 2022 also had a large depeg of LSTs due to looping, if I remember correctly. So not sure if this is part of the DeFi that should be protected by ETH holder dilution. They add validators, sure, but destabilize other parts of the ecosystem. In general, the stakers are getting paid by dilution of every ETH holder, mostly small amounts, but they are definitely getting diluted. One, you can think about it differently. If every year you have to take 0.86% of your ETH holdings and send it to Coinbase, probably the largest staker, Binance, Kraken, Bitmine, etc., would you feel that your money is well spent for the security you're getting? And would you be willing to pay up to 1.5% every year in a most extreme but unlikely outcome? In my view, the amount of ETH staked is already above what Ethereum needs to be secure. Staking ratio was stable for some years, but it started growing again and at the beginning of this year. For these reasons, I'm open to a change in issuance. But as said in my older post, it really depends on the proposed changes. Okay? Now, let's go to the specific proposal, EIP 8363, which tries to solve some of the issues. One goal of the proposal is to keep the ratio of ETH staked below 50%. Okay? The general issue this tackles is that if any system or economy starts to be dominated by a single mechanism or sector, this sector becomes, quote, too big to fail. This adds a systemic risk and fully entrenches certain actors at the core of the protocol. That is not healthy, especially not for the system or the economy as a whole. For this reason, I think keeping the staking ratio below 50% is a great goal. But with the proposed mechanisms, the EIP will achieve that, at least over a longer time horizon. The current issuance curve cannot guarantee anything like that. So I consider this a clear improvement over the status quo. The exact number of 50% is a bit arbitrary. In my simple view, one has to make sure it is clearly lower than 50% of the whole system. It could be 45% or even 40%. These are pretty much the same numbers in that context, at least. Issuance is a planned to transition smoothly in the sense that initially on the new curve, there is no APY change for stakers, and within 18 months, the lower curve is approached. As I consider this a good time horizon, and it prevents shocks in the ecosystem. That is necessary and reasonable. In a few years, if stake ratios increase with the current issuance curve, such a smooth transition will get more punishing and also more complicated. Not impossible, but more complicated. Now comes the most contentious part. Here we go. Solo stakers. The current issuance curve slowly marginalized solo stakers, and it will continue to do so. The proposed EIP 8363 does not change that outcome fundamentally, at least in my view. People make long economic arguments why the new issuance is better by leveling the playing field between solo stakers and professional ones. But as we have seen from the many solo staker opinions here and at other places, they pretty much only look at the APY to decide if they should stake or not. And with this proposal, the APY could potentially go to zero. The intricate economic arguments brought up might not really be important to solo stakers, even though they should be. So I do not think that this EIP can actually meaningfully diversify the staking landscape or even protect the solo stakers in any meaningful way. Well, that is not surprising. Issuance is just one lever, and it is pretty much impossible to find a good solution in such a complicated landscape by just having one lever to pull or push. Issuance is an important lever, and it can solve some issues Ethereum might encounter in the future, but not all of them. As written in the last post 3 months ago, which is linked above, a large issuance change for me is only acceptable in combination with additional safeguards to make sure that not only large entities grab the whole validator set. The most ideal way would be by being able to identify small stakers and giving them a higher APY. Unfortunately, there is no way to do this permissionlessly. The next best approach is to punish large stakers more if they make a mistake. This would improve the APY for solo stakers, at least relative to the more professional ones, and more importantly, to increase the cost for professional stakers, as they will have to separate their staking setup into smaller subgroups, so that only a smaller part is affected by a single configuration change. This would push the staking ratio equilibrium towards slightly higher APY. This punishing of large stakers would also help to diversify setups within large operators and strengthen Ethereum resilience at least a bit. One such proposal is EIP 7716, anti-correlation attestation penalties by Oysen Kind. It simply increases the penalties for missing attestations if large parts of the network are offline. Nowadays, such mechanism would only kick in when the network loses finality. With EIP 7716, this would already kick in at lower attestation failures and increase with more validators being offline. This would target mostly large entities. To be fair, though, it would also hurt a much broader part of the ecosystem if one Ethereum client would have a bug and stop attesting. I would expect if something like EIP 7716 gets implemented, more and more professional stakers would employ something like Vero and Vouch, which they should do anyway, and reduce these risks for everyone. In my view, we would need more than one EIP to actually improve the staking landscape without sacrificing the diversity that is actually needed to keep the network resilient. User UAP44 replies, well, this was a good read. Thanks for posting. It actually crystallizes a somewhat different concern I've been having throughout this whole issuance debate. You describe issuance as a lever. Ethereum issues ETH in order to purchase a particular service, namely sufficient network security. I think that's a useful way of looking at it. But it makes me wonder about the longer-term question. In bold font, at what point do we decide that we have found the right mechanism and stop pulling the lever? I'm open to the possibility that the current issuance curve isn't Ethereum's final one. Ethereum is still maturing. And if something like EIP 8363, perhaps together with a complementary mechanism such as EIP 7716, produces a substantially healthier long-term equilibrium, then there is a legitimate argument for changing it. What worries me much more is the possibility that issuance simply remains an ordinary protocol policy variable forever. As an ETH holder, there is a very significant difference between Ethereum is still trying to figure out its monetary security policy versus Ethereum's monetary policy is expected to remain subject to redesign indefinitely. I can accept the former. I would have serious trouble trusting the latter over the long time horizon. At some point, I want to be able to look at Ethereum and say, this is the issuance mechanism, the protocol that converged on. This question has been answered. Future generations are not expected to continually reopen it. Otherwise, the long-term trust assumption isn't only in the protocol, it's also an indefinite sequence of future researchers, developers, validators, and social majorities continuing to make good monetary policy decisions forever. And that realization is actually what pushed me into open this discussion on the magician. The broader issue, okay, and it goes on from there. I'm going to finish here. It says, I increasingly think the distinction between things Ethereum is still designing and things Ethereum considers finished is too foundational to remain implicit. And we shouldn't wait until Ethereum is supposedly, air quote, done before defining how we recognize that something is done. Because otherwise, there will always be another upgrade, another optimization, and another reason to postpone that conversation. Okay, without speaking too much on the proposals themselves, I would just say this. I'm not a big fan of ossifying issuance stuff, specifically because, I mean, Bitcoin's doing it and they have a security problem. I think that's kind of what makes Ethereum special, is that there is a lot more like active decision making over the long term. It's, there are certain things that do get held and kept and ossified to a degree, but I don't know. I mean, I think there is going to be this variable for the foreseeable future because things just ebb and flow. And if the technology changes, they're going to have to maybe redo the issuance side again too. We don't know. Well, we don't know. I just kind of very simply look at it like this. If we just stuck to the original Bill of Rights, issued in the United States for whatever, then I guess at certain points only people with property would vote. But we got rid of that, it's still like they still talk about voting and all the ways that people get elected. I'm just using the United States government. It molds and transforms and changes. It's an experiment at the same time. I think Ethereum's always going to be an experiment too, because it's like there is no final form of Ethereum that I see in the future. And I think that also carries over to the issuance side. I don't know. This is a good debate. It's got people paying attention. You can tell from this week's Doots. It's been a long, hot summer. This episode 155 kind of illustrates like there's never a shortage of people that are still here, still cranking away, and still giving a shit about what we're trying to build here. At the end of the day, I think everybody needs to focus on privacy and freedom. And those are the two things that go hand in hand. And the issuance part of it, it'll get settled. It would be kind of cool if there was a way to preserve privacy and freedom and be able to reward solo stakers, reward the decentralization, figure out a way to get these very large holders, get the ETH in smaller hands. I don't know how we're going to do it because it's a market, it's a market. It's big things to work on. Let's see. User Evil Jordan, also a fellow moderator. I nominated him. Is now ETH coordinate. There is a tweet on X. I've already liked it and I have already retweeted it. eStaker has rebranded to ETH coordinate. That was thank you, Evil Jordan. Evil Jordan this week is a duder number 24. Master Roshi getting another one on the weekly dudes. This is awesome. Let's see. We'll go in. Master Roshi discovers different ways to speculate on the newest DeFi primitives. Congrats on anyone that jumped into FWA, not sure what that is, and Stonk Broker after seeing this message. Let's see the message. This message will okay. So this is, it's this post about the on-chain innovation. So Master Roshi is doing the Doots the right way, bringing content and then reflecting on content, meaningful stuff here. However you feel about these actual products, remember you talk about the new games and the NFT stuff that's happening in DeFi. The amount of things being built on top of these is already impressive. It reminds me of the early DeFi summer days. Hopefully, the good times continue to roll for us, but remember to take profits on the way up and exercise proper risk management. But that's not why I'm making this point. Now that we may be nearing speculation season, was it sell in May and go away and then maybe come back in September? I don't know. I figured it'd be a good time to nerd out about my favorite way to responsibly speculate on tokens using DeFi. Allow me to explain what I do personally. Let's say, for the sake of example, that I want to budget myself 5 ETH to speculate with. Here's a couple of common ways people approach that, and the bonus way that I want to talk about. Number one, I simply spend the 5 ETH and buy my on-chain stocks or shitcoins of choice. Nothing fancy, it's just spending. Number two, take a loan on my ETH using cross-asset lending like Aave or Morpho. This requires using a healthy LTV to avoid liquidation. If my goal is 5 ETH worth of value to speculate with, maybe that means I have to collateralize something like 15 ETH to borrow 33% so I can survive and react to a potential ETH dump. The net result is that the target 5 ETH worth of dollars speculating and 10 ETH exposed to a smart contract risk and liquidation risk. 15 collateralized minus the 5 that you've taken out of. If you've collateralized an LST instead, then you can earn on your collateral, but it's basically still 10 ETH at risk. And number three, my favorite way, which is to take an Alchemix loan. Since Alchemix uses like-kind loans, price movements on ETH do not put you at risk of liquidation. And since LTV is up to 90%, you have to collateralize much less to get the same level of spend. You could, for example, collateralize only 5.75 and borrow 5 ETH of value to speculate with. But here's the thing. All of your collateral is in Alchemix. You're earning yield. So the net result here is 5 ETH to speculate, only 0.75 ETH exposed to smart contract risk, and 5.75 collateralized minus the 5 you've taken out of Alchemix. And at the same time, earning 2 to 2.5%. Another way of looking at this is that you only have 0.75 ETH exposed to smart contract risk, earning roughly 15% yield. The main difference between Alchemix and traditional lending platforms is that your collateral slowly repays your debt, ticking it down over time. So you lose the ability to hold the loan forever like in traditional lending platforms, assuming you could always responsibly handle your LTV and avoid liquidations. But you gain immunity to each price movements, higher yield, and less at risk in DeFi for the same level of upfront spending. People from our eFinance days probably know me already and are already familiar with Alchemy. But I've come to realize with the launch of V3 that a lot of people don't know about us. I've mentioned the fixed yield product in recent weeks because it's new, simple, and yields are good. But I still think our Vault product is the secret sauce. It provides an amazing way to control your spending and mitigate risk while doing so. I'm really proud of the products we've built, and I encourage you to check us out if you haven't already. Always happy to answer any questions about Alchemix as well. Well, son of a gun, Master Roshi 9, I'm going to change your tag here. You are on the Alchemix team. Alchemix team. Boom. That's good to know. I got that saved. Duder number 27, double dude of the week. Team member of Alchemix stopping by the Reddits. Good to see you. And finally, for this week, ETH Daily delivers the daily ETH news with the post coming in a new format. Okay. Nice. Happy Monday, they said. Today, I share my understanding of the issuance burn proposal. Solo stakers may still be first in line to hit negative yield. In today's news, Vitalik shared an Ethereum straw map overlay of the 2023 roadmap. ETH Labs released its week 7 update with 2 new hires and outlines its take on EIP 8360. Base turns 3, base, and introduces the Builder Grant Program. Hey, there's some money for some app builders. FWA generates more 24-hour revenue than Ethereum. Read more at ethdaily.io. We've got a daily Ethereum writer that's in our midst every single week. Well, let's see if there's any more podcast chat here. Oh, I'm opening up the podcast chat. You guys have been putting in the public stage. I got the robot figured out. I'm gonna have to test it real quick. If I had this thing set up to where it was supposed to funnel messages over to Restream, but I may have to reconnect. But anyway, we had a lot of people talking in the public stage chat on the old Discord, so that's cool. Yeah, very good. It's all good. Next Level Fantasy, I gotta fix the chat settings on Restream. I had it set up to where if you're on Discord and you type in that Doots podcast chat channel, it would populate over to Restream, and then actually have the Restream chat window right there, right below my chin that I need to shave up a bit. And those comments would show up there, but alas, it didn't work. And it's okay, because the show's over. And that means you'll have to tune in next week. We're going to have team member from Quotient. And we're going to have Zal from the Zao. I hope I said your name correctly, Zur. And going to be joining the podcast, let's see, on the 28th. Man, we still got 2 more weeks of this August heat to get through. Well, that's all there is to this episode. We'll just cut it right there. Thanks so much for smashing, subbing the bells, or whatever you're supposed to do on all these darn channels. We're really glad everybody could hang out today. Thanks so much for giving us a follow. But more importantly, stop by the daily general discussion on Reddit. And then tune into this show every week that we do these podcasts. I read Reddit, so you don't have to. On behalf of the EV Mavericks DAO and the daily general discussion on our Ethereum, my name is JT. Cheers and big hugs from Kansas City.